Good morning, everybody. Welcome back to the Opportunistic Trader. It's just after 10 a.m. on December 19th, Fed Day, and we're joined by Adam Collins. Adam's been joining us regularly to discuss market seasonality, latest CoT reports, a lot of great information. How's it going today, Adam?
It is going pretty good. I'm glad we fixed the tech stuff, and let's get into it. Okay, so none of this is investment advice, so don't treat it as such. And for any new listeners out there, main thing I talk about is the CoT report. Shows how people are positioned in the futures markets. You have these different categories of traders, right? You see what they're long, what they're short. Knowing that, you can calculate their net positioning. But what I like to look at is the sort of the extremeness or not of the net positioning over the past 5 years. And the main indicator for that is a percentile. If it's 100%, people really bullish. 0%, the opposite. So let me go right into some of the interesting graphs. Okay, so this is sort of a different way to look at CoT positioning. Right now, cocoa producers are running a low amount of hedge exposure, meaning that like they're not locking in current prices for their future production. And like this positioning is sort of similar to what it was like in late 2016, early 2017, which is right before a big move in cocoa on the upside. And then we've got copper was also interesting to me because it's moving now, but the big move in positioning happened in like late June, early July. That's when we went from like this super crowded net long trade, specs for net long, like 5 billion up here, it completely washed out, right? And so this isn't to say that traders are, really bearish on copper. In fact, they're still slightly net long. But we've had a really big move. And for people to say, traders are, bearish on like the global growth narrative and they're super pessimistic on copper, we definitely have to see this go into like net short territory, like, between 2010 and 2014. The timing of it which was just sort of weird to me in that, we had this, big one-off move in positioning and then price sort of echoed it a little bit. Then we've got, I want to look at corn too. So like, when traders have gotten net long corn roughly 5 billion or so ever since like 2013, 2014, that's been like this, almost like the ceiling on the short-term price of corn. It's always marked, short-term price reversals. And I say this because, traders have been getting more bullish on corn. And so it bears watching if spec positioning gets up to these sort of like no man's land levels. And then we've got gold right here. So gold, there's definitely been an uptick. So like this is looking at spec positioning as a percentage of open interest. And then this is looking at their positioning in dollars. And so we've definitely had an uptick. We've gone from, a net short to net long like 10 billion, but net long 10 billion in gold is still historically quite low. And so traders definitely aren't, quote unquote, like all in on gold again. And then we've got, I want to look at heating oil over here. Let's see. Yeah, so CoT worked sort of like unusually well in heating oil and RBOB this most recent time around, like the recent drop. Like you can see, like, traders were super net bullish right before, it was a complete like rug pull against them. But anyways, so current spec positioning in heating oil is right around these levels over the past couple of years of where, heating oil has sort of turned around. And so I definitely think, and obviously, yesterday's move is big, et cetera. The crowded long that like the recent move in like WTI and heating oil, it was so indicative of like liquidation. Like it was this one-way freight train. And there's just a lot less money now. In the long side in both WTI and all these, like refined products. And then OJ is interesting in that, yeah, it's like the number one most crowded commodity spec short trade. Traders are net short like 120 million, which is like it's a 12-year low in positioning. What else? We got platinum over. There's OJ. Okay, here's platinum. So what's sort of weird to me is that, platinum has been grinding down. It's been this sort of steady downtrend. And then earlier this year, June, July, August, traders were very short, right? So they were more net short than they've ever been over the past 5 years. We got like this mild bounce and there's a lot of short exposure that was covered. But right now we're pretty much back at the lows, but spec positioning is not at these, pessimistic extremes. So what it means is that, let's say let's say platinum clears like 750 on the downside. There's probably a lot of CTAs out there who are not in short yet, but can sort of like rejoin the position just because it's not nearly as crowded as it once was. And then that's not the case in palladium. Palladium stands out. It's the one precious metal that's really, gone higher in 2018, and spec positioning reflects that. And then we've got silver. Yeah. So sort of like gold, a little less so. So like traders have been a little less reluctant or a little more reluctant to pile back into silver on the long side. Traders are net long. I think it's like right at 1.9 billion, which is, it's a little bit of a rise, but it's still big picture. Not a lot of people are interested in silver on the long side. And then we got WTI. Oh, this is soybeans. So yeah, soybean producers, sort of similar to cocoa actually right now, where they're carrying very little short exposure for their future production. And so what this says, in plain English, is that you've got soybean producers who are looking at the current price saying, hey, we're not super interested in hedging at these levels, for the next couple of months. We've got WTI. So yeah, talked about it, I think, last week, but WTI, it's been this spec positioning, huge unwind. And after yesterday's move, I wouldn't be surprised if positioning sort of like, even went below the June 2016 lows of like net long 17 billion. So we're definitely, getting into the really, really pessimistic positioning of late 2015, early 2016. And this is the same view. It's not in dollars, but in a percentage of open interest. And then we can turn to currencies. Currencies, I've got it pulled up. So traders have sort of gotten more net long in Aussie dollar, which has sort of been, going against them. It's sort of interesting because you tend to see positioning and price action run in tandem. British pound positioning's mixed. How much to write about? Canadian dollar, traders have gotten, more net short as crude's been weak. Euro, really nothing. The trader spec positioning's right in the middle of its 5-year range. We came off, the really sort of the big net long of Q1 this year. The yen is probably the most notable currency positioning chart in that traders are just so net short. And so I'm definitely paying attention to that. Peso, traders have trimmed long exposure. New Zealand dollar, the crowded short that I talked about, for a while, doesn't really exist anymore. A lot of short exposure was covered. And then Swiss franc. Swiss franc, sort of like the yen, and that traders leaning short, but this isn't as extreme as the yen. And then we can turn to stocks. In fact, for stocks, I'm just going to look at these charts. So, and here's some other ways to look at the currency stuff I just talked about. We got Aussie dollar, we got Canadian dollar, euro, still sort of like net long 10% of OI. We got yen, very crowded on the short side, and then we got Kiwi dollar. Anyway, so for S&P, it's been interesting. I know like the big moves were obviously, Friday, Monday, which is sort of like past this report state, but still, given weakness and given like as of last Tuesday's, distance from all-time highs, I really would have expected net spec exposure to be lower. Like there's still, as of last Tuesday, net long like low 50 billion, like low, 52 billion or so. And it's a lot of money. I know it sort of looks like a small amount relative to the January highs, but if you sort of like hide this on a chart and you just look at, what's been extreme ES positioning or not over the past 12 years, net long 52 billion has been a really high reading. Now this is just in the ES. This is in all three. So it's, the E-mini, S&P, NASDAQ, Dow. It's pretty much the same chart as the ES, just because the ES is like the dominant contract. But the sort of difference between the two is that you can see it. This is sort of a little bit lower. It's because traders have been quicker to get pessimistic on the NASDAQ as opposed to the ES. It looks less extreme. So, sometimes it's worth normalizing just as a percentage of open interest. And then we've got Japanese stocks here. Sort of crazy to me that traders are this bullish given how weak they've been. That sort of a positioning being divergent from price action. VIX is definitely up there for the most interesting COT stuff. We've got probably my favorite chart right here, which is dollar spec exposure to VIX futures, and they're net long like 700 million. So we're and this doesn't even reflect obviously like recent moves higher in the VIX. And so if this Friday we get the COT report and we see spec exposure has risen above 1 billion net, that's like very rare territory. Every single time it's gone there, be it summer of 2011, February of this year, it's always been sort of like a level that it's paid to fade against. Now, obviously, if the correction further develops, that will look stupid. But either way, regardless, spec positioning in VIX is definitely getting near extreme levels. And then let's see what else. I think that was that's it for COT stuff. I'll turn to some seasonality stuff. So December is more than halfway through, but historically the best performing contracts have been palladium, cotton. Definitely working this month in palladium. OJ has been a bad performer in December, which is sort of true this month actually. But let's look at January seasonality, January and February. So main dominant thing for January, February has been precious metal strength. You can see all four right here. Now this is looking at average monthly performance over the past 20 years. And we can see that on average, the best performers have been platinum, silver, palladium, and gold. And if we go to February, more of the same. So we got palladium up there, platinum up there, silver, and then gold a little less so. But either way, January don't necessarily expect, but be aware of the historical seasonality of precious metals. But if you look on the right-hand side, contracts that have historically done poorly in January have been some of the agriculturals, crude a little bit, euro, nat gas, and then we can look at term structure, which contracts are in contango, which are in backwardation. Nat gas still quite backwardated, and then contango still steep in corn and coffee. Momentum, best performers, worst performers over the past year, sort of a proxy for like long-term trend following sentiment. Nat gas, best performer, followed by wheat, cocoa, palladium. Worst performer, lumber, which was definitely not the case earlier this year. And then this is another site I run. And I'm not going to go through like each indicator, but the ones that stick out right now that seem like very timely and relevant are the fact that, momentum as measured by like 12-month momentum is right on the verge of dipping negative. So a lot of trend followers, use this as a metric to dictate equity exposure. And now shorter term trend followers definitely out, right? They've made their changes. Longer term trend followers, they're going to get quite close to cutting equity exposure if the S&P drops, another 2-3%. Other interesting stuff was obviously today, FOMC drift. And so that's a historical tendency of equity prices to rise ahead of FOMC announcements. This is not super relevant anymore. So this is what's relevant. So we're actually just now entering the blackout period for companies when they will announce, Q4 earnings over the next couple of weeks, months. Now you can see it with the blue line. As long S&P exposure, when we've been outside of the blackout period, the non-blackout period has historically been like significantly better than long S&P exposure just in the blackout period, like we're in now. And so, yeah, that's something to watch. And then also is margin debt. So margin debt is starting to contract year over year. The first time it's happened since like early 2016. Now, a lot of people with margin debt, they get sort of spooked when they see like this big chart of, a big amount of margin debt outstanding. The way I look at it is more so a year over year change. Like, are people leveraging up or cutting leverage? And they're definitely cutting leverage now. And historically, the two extremes have mattered for margin debt. You've had these crazy, blow off tops where people have, like right here, May 2000, traders had put on 80% more margin debt, year over year, which is a huge move, right? That's a quick increase in leverage. Exact same setup in late 2007. But on the flip side of that, of sort of the extreme optimism, is the pessimism of people starting to, pull back on leverage. And that's where we're at right now. And historically, that has not been a good time to have long S&P exposure. Sentiment wise, it's everything you'd expect of all these surveys are indicating, more pessimism. Like AAI, so you've got, more bears here, less bulls. Then you've got put call ratio. It's on the higher end of its past couple of years, but it's not the crazy highs of September 2015. Now, I also should point out this is a 4-week average of it, so it's not going to be like the most sensitive current reading. But yeah, that's pretty much it with positioning, seasonality, and some S&P stuff. So if anybody's got any questions, I'm happy to answer them.
Yeah, thanks a lot, Adam. A lot of great information there. I guess the question is, with all the volatility of late, what in your analysis looks interesting right here? What looks like an opportunity? We've talked about crude oil for a while, but we've seen an extreme move in oil where we were trading above $77 and now we're trading at $47, and we did that in a matter of a few months. So what kind of sticks out? I know we've talked about oil for a while, but is there anything else with the volatility in equities, commodities?
Yeah, it's a couple things. One, in currencies, the fact that the yen is such a crowded short, and if we were to sort of get, I don't know, I mean, more of a downside in risky assets like stocks, you could have think of it as sort of like an accelerant to the yen, which is a risk off play. And so positioning still sort of like very much not prepared for any yen strength. VIX futures, this chart like right on my screen right now, it's definitely one of the more interesting to me in that we're not in uncharted territory for VIX positioning, but we're getting close to it. And then yeah, so I'm going to be very interested to see what chart is it. I think it's this chart. After with this Friday CoT report, it'll fully reflect like the two recent big down moves in the S&P. Basically, I want to assess how much positioning drops. If we go from something like, net long 52 billion in the S&P to like net long 2030, that's a huge drop, right? But it would blow my mind if it didn't drop a lot. So like what that means is that, people are sticking with their positions. And when people are sticking to their positions, when they're going against them, it makes them more vulnerable to sort of like a forced capitulation. And so, yeah, definitely going to keep an eye on, S&P positioning with the other commodities. Yeah, like I said, there's some interesting stuff going on in corn where it's like, strangely enough, that sort of spec level of like, once they get net long 5 billion, corn is like always rolled over. So if you're involved in, I guess, agricultural commodities, keep an eye on that. And then that's pretty much it. Is VIX, yen, corn, S&P, and then yeah, be aware of typical Q1 strength in precious metals.
Yeah, it's interesting. With dollar yen specifically, in the past, it's been very tied to risk on, risk off, and the fact that I'd argue we're actually holding up pretty well in dollar yen here at the 112.20 level, given the S&P basically this month we traded up to 28.14 at the first day of the month. Remember, after G20, and here we are. Yesterday we traded down to 25.30. So we've had a significant move in equities, risk off, and oil, things like that, and dollar yen's held up pretty well. So that's interesting.
Yeah, no, for sure.
I guess what seasonality wise, we're getting into the point now, basically after today, where typically, 95% of the time is seasonally favorable for equity markets into the end of the year. Is there something telling you? Obviously, it's a significant down month as of right now. Is there anything that other than other seasonality, other products that should start to move based off of what has happened in the past few years into the end of the year?
Into end of year, I don't really get into like intra-month seasonality. As granular as I get is like monthly, but
right.
Yeah, like this chart shows, December has typically been most strong for like palladium, cotton, and then sugar. But I want to check this out. So if I go to the S&P seasonal chart, what it'll show is what you're interested in, which is the intramonth stuff. Oh, whoops, clicked on energies. Yeah, and while I'm loading this up, I'll be the first to say that like seasonality to me is one of the more marginal indicators. Like it takes a backseat relative to other stuff. Anyways, okay, so you can see, so this chart, the orange line is sort of like it's the 5-year seasonal average. And what you can see right here is that does sort of exist of where, first half of December, not really much. And this back half is when you've got over the past 5 years on average, like a plus 3% move. I would assign less weight to the 5-year and more weight to the 10 and 20. And it's with S&P seasonality, the more important thing isn't so much like this, this intramonth, like back half of December pop. It's more so the fact that like October to April has historically been a very strong period. And if you want to see like more evidence of that, there's another graph on this site right here, and it's like the simplest indicator in the world. The blue line says, "Hey, only be long S&P November 1 to April 30," and the orange one says, "Only be long the other 6 months of the year." And so, what the blue line shows is basically that November 1 to April 30 has been like
Right.
an order of magnitude stronger. And I know that like recent price action doesn't agree, but if you do want to know S&P seasonals, there they are.
Yeah, no, you've shown us that chart in the past, and it's a great chart. A lot of great information there. Any closing thoughts, I guess, for what, into the end of the year, beginning of 2019?
Yeah, in terms of like, I notice like people always become most interested in positioning like right when they shouldn't. So for example, I've had questions and stuff about, WTI positioning recently, and like the time when you should have been worried about that was months ago when it was clearly like, this like the COT thing of where there was lots of spec long exposure, right? And so what I'm getting at is a lot of the big moves have happened in the crowded trades of 6 to 12 months ago, and I would say don't let that sort of thesis back you up for like short WTI right now, because there's just less of there's less long exposure, and I would focus more on the contracts where the extreme positioning is intact, as opposed to the stuff where it used to be extreme but just not so much anymore. And one last thing I'll pull up that you might find interesting is no, it's not it. Is basically I can narrate it. So in the 10-year, so some people have been focused on bonds recently, right?
Yep.
So in the 10-year, positioning surprisingly hasn't changed that much. So remember, a couple months ago, it was sort of this two-stage thing of you had asset managers very long and then leverage money very short. So it was sort of like slow money bought the dip in the 10-year, and then fast money were like crowding the short trade, right? And so I sort of refreshed on that this morning, and I expected to see leverage funds cover a lot of their short exposure because we've had a big up move in the 10-year, and we didn't really have it, which caught me off guard. And so I guess for bond people out there now, huge caveat: COT only looks at bond futures, not cash bonds. But basically, there hasn't been a lot of short covering in 10-year. So if your thesis is, well, hedge funds and leverage funds, they're still really short the 10-year, that actually still is true. That hasn't changed.
Interesting. Yeah, a lot of great information as always. So Adam Collins has many different websites. He is the founder and portfolio manager for Movement Capital, which is movementcapital.com, freecotdata.com, simplestockmodels.com, and commodityseasonality.com. We really appreciate the help, and good luck trading later in the day with the FOMC.
Yeah, thanks so much. See ya.